Welcome to the Opening Bell Report.
Okay, let's unpack this. Today is Wednesday, February 25th, 2026. And if you were, if you were anywhere near a trading screen today, or heck, even just scrolling through financial news on your phone, you probably saw something that looked like a glitch in the matrix.
Yeah, it was definitely one of those days.
Right, where you're looking at a stock move that didn't just climb, it didn't just rally, it effectively detonated.
You find yourself refreshing the data feed because the numbers, they just don't seem to reconcile with reality. I mean, you're seeing a percentage gain that usually takes a company 10 years to achieve, and it's happening in about 6 hours.
Exactly. We are looking at XWEL Inc. Ticker symbol is XWEL. Now, usually this is a company that flies completely under the radar. It's a micro cap, but today it sent absolute shockwaves through the market.
It really did.
We're talking about a gain of over 220% in a single trading session.
Parabolic. That's really the only way to describe it. It's completely disconnected from gravity.
And that is exactly what we are here to do today. We're going on a deep dive into XWEL. We need to look past that flashy percentage gain because seeing green numbers like that triggers a lot of FOMO in the lizard brain.
Oh, absolutely.
Because we need to understand why it happened. But more importantly, we have a detailed analysis report in front of us today. And based on that, we really need to talk about the massive catch hiding in the details.
Right, because often when you see a move this violent, there is a mechanism behind it that just isn't immediately obvious to the retail investor who's just looking at the headlines.
They just see the big green arrow.
Exactly. But there is usually a very specific mechanical reason for the move, and an even more specific reason why it might not last.
So today we're working off this analysis report regarding XWEL's breakout, their profit potential, and the very serious dilution risks involved. Whether you are looking at that ticker right now with a serious case of fear of missing out, or you just love a good financial mystery, we are going to separate the hype from the reality.
It's a classic case of look at the shiny object while the machinery in the background is doing something completely different.
I love that image. Okay, let's set the scene. Take us back to the opening bell this morning. What exactly happened when the market opened for XWEL?
Well, to understand the violence of the move, you have to look at where we started. You really have to understand the baseline here. Yesterday, Tuesday afternoon, XWEL closed at 38 cents.
38 cents?
Yeah.
Okay, so we are firmly in microcap territory here. This is a penny stock.
Precisely. It is a tiny company. For context, before today, the entire company was worth roughly $6 million. That was the market cap. In the world of public markets, that is microscopic.
So 38 cents close, then the sun comes up this morning. What happens?
When the market opened this morning, it didn't open at 38 cents. It opened at 81 cents.
Whoa, hold on. So it didn't trade up to 81? It didn't climb there over the first hour of the morning?
No. It just appeared there. That's called a gap up. An immediate overnight repricing. Before a single regular session trade was executed, the stock was already up 113%.
That is wild. Explain that feeling for a trader. Because if you are holding that stock, that has to be a dream scenario.
Oh, it's euphoric if you're long. Imagine waking up and your house is suddenly worth double what it was when you went to sleep.
Right.
But for a short seller, someone betting against the stock, it is a absolute nightmare scenario. You are instantly underwater with no chance to get out.
Yeah, you're just trapped. But here is where it gets fascinating. It didn't stop at the open. That 81 cents was just the starting gun.
Correct. The gap up drew a massive amount of attention. It put XWEL on every top gainers list in the world. So the volume just started pouring in.
Yeah.
We were talking day traders, momentum algorithms, chat rooms. Everyone saw this moving and piled on.
The frenzy.
Total frenzy. The stock climbed all the way to a peak of $1.62.
$1.62. So if you're doing the math from the previous close, that is a 326% intraday peak.
Which is staggering.
Yep.
Now, it eventually cooled off slightly to settle at $1.21, but even with that pullback, you were looking at a close of plus 220.1% for the day.
Which is astronomical. I mean, in a world where people are happy with 8% a year from an index fund, 220% in a day is life-changing volatility.
It really is.
But this brings us to the million-dollar question, or I guess in this case, the multi-million-dollar question, why? Why did an airport wellness company suddenly triple in value? Did they invent a massage chair that travels through time?
Not quite, though that would certainly justify the valuation.
Yeah.
No, the catalyst here was purely financial. XWEL announced a massive private placement deal. They secured $31.3 million in gross proceeds.
Okay, $31.3 million. In the grand scheme of the S&P 500, that is a rounding error. A big tech company probably spends that on snacks for the break room.
Right.
But we have to look at it relative to XWEL.
Right. That is the crucial context.
Yes.
You cannot look at the absolute number. You have to look at the relative scale. Before this news dropped, remember, XWEL's entire market capitalization, the value of all its shares put together, was hovering around just $6 million.
Wait, let me get this straight. The whole company, every share, every lease, every share was worth $6 million.
Yes.
And they just got a check for $31 million.
Exactly. That is a 5x multiple of their previous total value just handed to them in cash.
That is insane. That's like, okay, let's use an analogy. Imagine an individual with a net worth of, say, $60,000, and they suddenly win a $300,000 lottery jackpot.
That is a perfect analogy.
Yeah.
It is a monumental, life-changing amount of capital relative to the size of the entity. It completely changes the balance sheet overnight.
So I can see why the market went nuts. This is the bull case, right? This is the headline reaction.
Right. If you just read the headline, it looks like a miracle. It is a lifeline. This company was struggling, likely facing liquidity issues, maybe even staring down bankruptcy. Suddenly, cash is no longer an immediate problem.
They can breathe.
Exactly. It removed the immediate threat of going under. It allows them to restructure, maybe pay down some debt, and keep their airport spas and wellness centers operating.
So the market sees the cash and thinks, they are saved, the risk is gone, bye, bye, bye.
That's the initial knee-jerk reaction. Everyone's thinking, look at all this cash per share. The cash alone is worth more than the stock price was yesterday.
Right.
But in these situations, you have to ask the uncomfortable question. Where did that money come from?
Yeah.
And what did they have to promise to get it?
Here's where it gets really interesting. And honestly, a little scary for the average investor. We need to pivot from the good news to the warning in the analysis report. Because nobody just hands over $31 million to a struggling microcap out of the kindness of their heart.
No, they certainly do not. Institutional investors are not charities. They are in the business of making guaranteed returns. This wasn't a standard bank loan with a nice little interest rate. This deal involves something called Series H convertible preferred stock and warrants.
Series H convertible preferred stock and warrants. That is a mouthful. And just saying, that sounds expensive for the existing shareholders.
It is remarkably expensive in terms of equity. It's what we call toxic financing in some circles, although legally it's just a private placement. Let's break down the dilution aspect because this is what kills rallies.
Okay, walk us through it slowly.
To get that $31.3 million, XWEL agreed to let these institutional investors, the ones giving the money, convert their preferred shares into common stock.
Okay, so they hold these special preferred shares, but they can flip a switch and turn them into regular shares that trade on the open market.
Yes.
How many shares are we talking about?
Roughly 66.6 million new common shares.
66.6 million. And remember, the company was tiny before this, so they are essentially flooding the market with paper. But the number of shares isn't the only thing that matters here. It's the price, right? What is the strike price?
That is the critical number. The strike price for this conversion is just 47 cents.
47 cents. Okay, let's pause there and let that sink in for you listening. The stock closed today at $1.21. It peaked at $1.62. But these investors have the right to create shares for 47 cents.
Correct. They are sitting on an asset that costs them 47 cents while the market is screaming, I'll buy it for $1.20.
That's an incredible deal for them. But wait, you said warrants too. Does it get worse?
It gets significantly worse. We haven't even talked about the warrants yet.
Yeah.
This deal also included warrants to purchase another 66.6 million shares.
Another 66 million. So we're talking over 130 million potential new shares.
Yes. And the exercise price on those warrants is even lower. Those are exercisable at $0.345.
$34.5 cents.
34.5 cents.
So let's connect the dots here for the listener. The stock is trading wildly, hitting $1.60, closing at $1.20. Everyone is excited. Retail traders are high-fiving each other, but there are sophisticated investors sitting there holding a contract that lets them buy shares for literally pennies on the dollar compared to the current market price.
That is the very definition of an arbitrage incentive. It creates a gravity pull on the stock price. Think about it from the perspective of the institutional investor. You can acquire shares for under 50 cents via that conversion. You can see the market is in a frenzy, buying at $1.20, $1.30, $1.40. What do?
You sell. You don't hold for the long term. You sell everything you can.
You sell immediately. It is guaranteed risk-free profit. It is not investing. It is just math. You are buying a dollar bill for 35 cents and selling it to a retail trader for $1.20. You would do that all day long until the prices match up.
So essentially, they are deeply incentivized to dump shares, which just floods the market with supply.
Precisely. And in the stock market, supply and demand is the ultimate law. It doesn't matter how exciting the news is. When you have Potentially 130 million plus new shares hitting the market. Shares that were acquired at a fraction of the current price. The sheer weight of that supply is going to drag the price down.
It's like gravity. You can't fight it forever.
You really can't. The analysis report suggests this supply flood is highly likely to drag the stock price back down toward that 47-cent conversion level. Because as long as the stock is above 47 cents, the investors are making free money by selling.
Did we see any evidence of this happening already today, or is this just a theoretical risk?
Oh, it is already happening. The report pointed out that this reality was setting in during after-hours trading.
What happened after the bell?
The stock began pulling back significantly, dropping to around $1.13 shortly after the close. That initial euphoria wears off, and the math starts to take over. The smart money starts executing that arbitrage, selling into the retail money that is still buying the hype.
It's a brutal cycle. And that's just the mechanical side, the share structure. But what about the business itself? I mean, $31 million is still a lot of money. Does that fix the company?
That is the other side of the coin, the fundamental picture. We have to remember why they needed this money in the first place. This isn't a company that is growing like a weed and just needs cash to expand faster.
Right. The analysis mentions their financial health. What is the actual status of the business?
The report highlights that XWEL's revenue has actually been shrinking. The company operates at a heavy loss.
Okay, so people aren't spending as much at airport spas, or maybe the business model itself is struggling.
Exactly. The business fundamentals haven't magically been fixed just because the bank account is suddenly full. The expert view in the report here is that this $31 million is a survival mechanism. It buys them time, it keeps the lights on. But it is not necessarily a growth catalyst.
That is a key distinction I want to drill down on. A growth catalyst versus a survival mechanism.
Think of it this way. A growth catalyst is when a company raises money to build a new factory, or launch a new product line, or acquire a competitor, something that will generate more revenue in the future.
Okay. And a survival mechanism.
The survival mechanism is when you take out a high-interest loan just to pay your rent so you don't get evicted. You aren't growing, you are just delaying the end. In this case, the cost of paying that rent was severe dilution to the existing shareholders. They saved the company, but they sliced the pie into hundreds of millions of tiny new pieces to do it.
So if you owned 1% of the company yesterday, today you own a fraction of that because so many new shares were created out of thin air.
Exactly. Your slice of the pie got microscopic.
So let's try to figure out who this stock is actually for right now. Because with 220% volume, clearly someone is trading it. Millions of shares changed hands today.
The report breaks this down into two very distinct perspectives. It is crucial to know which camp you fall into. First, you have the day traders.
The adrenaline junkies. The folks glued to the screens with 6 monitors.
For them, XWEL is currently a playground. It's a playground of extreme volatility. When a stock moves 20, 30, 40% in minutes, there is massive money to be made if you are on the right side of the trade. They don't care about the company's long-term future. They care about the price action in the next 5 minutes.
High risk, high reward.
Extremely high risk. The report emphasizes that this requires strict risk management and tight stop losses. You cannot marry this stock. You date it, you have a quick dinner, and you leave before the check comes. Because if you get stuck holding the bag when the dilution hits, you get crushed.
And what about the second group? The long-term investors. The diamond hands crowd who looks at this and thinks, this is the bottom, I'm holding for gold.
For them, it's a trap.
Blunt. I like it. Why is it a trap?
Because the fundamentals haven't changed. And the incoming wave of dilution makes holding long-term incredibly risky. If you buy this at $1.20 expecting it to go to $5 purely on business growth, you are fighting against a mathematical tide of cheap shares that need to be sold.
You're betting on the horse to run faster while the jockey is actively adding weights to the saddle.
That is a great way to put it. The institutional investors are adding weight with every single share they convert and sell.
So the synthesis here is respect the momentum. Because a 220% gain is historic and real money changed hands today, but do not ignore the math.
Exactly. Do not ignore the dilution. The math will win in the end. Markets can stay irrational longer than you can stay solvent, as the saying goes, but eventually supply equals demand. And the supply here is massive and cheap.
It usually does. So to recap this wild ride for you listening, we saw a 220% explosion in XWEL stock today. We identified the catalyst as a massive $31 million lifeline, but we also uncovered the trapdoor. Over 130 million new shares waiting in the wings, priced at pennies, ready to dilute the stock price back down to earth.
It's a classic example of headline news versus mechanical reality. The headline says cash injection. The mechanics say dilution flood. And if you don't read the fine print or listen to deep dives like this, you miss the mechanics.
And that brings us to the end of this deep dive. But before we go, I want to leave you with a thought. When you see a company's stock price disconnect this violently from its fundamentals, thanks to a complex financing deal like this, you have to ask yourself a hard question. Are you betting on the future of the business? Or are you just providing exit liquidity for the institutional investors who got the cheap shares?
That is the question that separates the pros from the game.
Don't forget to like, share, and subscribe for more.